In today's video, we're taking a closer look at a company that many people wrote off. Yet it quietly delivered one of its strongest financial years ever. Lyft. You've probably seen the pink logo on cars everywhere. But what you might not know is that Lyft is now operating in one of the most uncertain and potentially most profitable periods of its entire history. Some analysts say Lyft is becoming irrelevant. Others say the market is massively mispricing the stock. So the real question is Lyft on its way out? Or is it one of the most underrated opportunities in the transportation industry? Let's break it all down. 1. The reality people overlook about Lyft. Most people think Lyft is just another Uber competitor. But the company plays a much bigger role than most realize. Lyft has built a two-sided network. One side connects drivers who want to earn money. The other side connects riders who want fast, affordable trips. And here's the part most people forget. Lyft's entire model is powered by data, millions of trip patterns, pricing signals, geographic demand maps, and driver behavior metrics. This data is the backbone of their business. The stronger the network becomes, the harder it is for competitors to replicate. And right now, Lyft's data advantage is bigger than ever. 2. The shadow over Lyft, autonomous vehicles. Now, let's talk about the elephant in the room. Self-driving cars. For years, the ride-sharing industry has been racing toward a driverless future. Companies like Tesla, Waymo, and new autonomous startups are promising a world where cars can operate without human involvement. This could change everything. No drivers, lower operating costs, faster routes, more efficient scheduling. And for a company like Lyft, this creates a massive question. If human drivers disappear, what happens to Lyft? Now here's the twist. Lyft is not ignoring this future. In fact, the company is already working on infrastructure to support multiple autonomous fleets, meaning Lyft could still be the platform people use, even if cars drive themselves. Lyft doesn't have to build the cars. It just needs to provide the network. And that's an advantage very few people talk about. 3. The part nobody expected. Lyft is generating real money. The most surprising thing about Lyft's latest financial performance is simple. The company is actually profitable and getting stronger. Over the past 12 months, Lyft produced over $1 billion in free cash flow. Its free cash flow margin hit 16%. Operational efficiency reached record levels. For a company that many people assumed was dying, Lyft is showing the opposite. Even more interesting, the stock is trading at a valuation far lower than most companies with similar profitability. This disconnect is why some long-term investors are paying attention. 4. The numbers show a very different story. You can judge a company by its stock price, or you can judge it by how customers behave. Customers don't lie. In Lyft's most recent quarter, total riders reached an all-time high. Total rides broke company records. Gross bookings were the highest in Lyft's history. In other words, people are using Lyft more than ever. That's not what a collapsing business looks like. That's what a deeply positioned transportation network looks like. 5. So why is the stock still so cheap? There are 3 reasons a market hasn't caught up. Reason number 1, fear of autonomous disruption. Many investors think self-driving cars will make Lyft irrelevant. Reason number 2, past losses. During the pandemic, Lyft struggled. That reputation still sticks with the company. Reason number 3, Uber dominates the headlines. Uber's global size overshadows Lyft's progress, even when Lyft shows stronger margins. But here's the truth. A stock can be undervalued for emotional reasons and still be fundamentally strong. Lyft fits that category right now. 6. The potential upside, where Lyft could go from here. There are two paths Lyft could take, and either one could benefit investors. Path number 1. The market finally revalues the stock.